really looking forward to being together again in New York City at the end of May for Cycles in the City 2026.
It's going to be thrilling to be there. I'm looking forward as well, Richard. It's going to be a crackerjack. I'm going to bring some really juicy stuff. You bet, absolutely.
Welcome, Larry. It's great to be with you here, and thanks so much for joining me today.
Always my pleasure. Yeah, I always love to talk about cycles.
It was an incredible conference last year, wasn't it?
It was not only because of the presentation, but to meet so many people, in my case, to catch up with people I haven't seen for 10, 15 years and be with real legends in the business. So it was a great combination, a lot of talent, a lot of input. It was an amazing presentation that what you're doing is sustaining this belief in cycles and a central place for it. I mean, it's so necessary, not just about the stock market, about cycles and everything. And so I just really congratulate you for doing it, Richard. I think it's just an
Oh, thank
awesome
you so
idea.
much. That means a lot to me. And one of the things I really appreciated you bringing up last year was how important it is to really know the people that are doing this business, right? That are trying to understand cycles. And you have met so many of the legends who aren't even with us today anymore. I mean, you were talking about, I mean, did you meet Edgar Lawrence Smith?
No, I never met him. I
You
of
never met
course
him?
met Art Merrill and W.D.
You met Art
Gann's son,
Merrill.
John Gann, and Parnell McKenna. There are, some of these people I can't remember, but James Dines, George Lindsay, Marty
James Dine,
Zweig. I mean, we were all, yeah, we were together back then.
Wells Wilder.
Well, I started Wells in business.
You're kidding.
No, Wells came to me
What?
and
Tell
said,
me that story.
he said, Larry, I have an idea for a strategy I want to sell, but I don't know how to sell it. Do you have anything you could help me? I said, well, I have a mailing list. You could try. That's good. And that started Wells. Wells really represented a group of people, Gresham Northcutt, another guy's name, Ray, think of it in a moment. And there were 3 or 4 of these guys that came up with the ideas that are in Wells' book. Well
Hmm.
was an engineer and orchestrator and helped with some of them, but Gresham Northcutt did a lot of the work in that particular book.
Wow.
But Gresham was a great promoter, and first time I met Gresham was in China. I was sitting in a bus at Tiananmen Square. I looked down and said, "That's Wells Wilder."
What?
People, nobody knew it was. I said, "That is." I hopped off the bus. They ran. Sure enough, well, Wells, what are you doing here?
You
So it was,
bumped in. You saw Wells out of the side, out of a bus
yeah,
window
I
in
looked out the
China.
bus window. I saw it in Tiananmen Square. And I said,
What?
"That's Wells." Yeah. I recognized the toupee he had on it. Went out and saw it. I was like, this is
Wow.
amazing. And then when he did Delta, he invited me to his house to come see what he was doing with Delta and how they did all that. So yeah, so many of these people. I mean, because back then we did live conferences like what you're doing. We
Hmm.
knew people. I got drunk with Joe Granville, played pool with him one night. I mean, I got some great stories about these people. Unfortunately, they probably do with me as well. But
Uh,
there was
right.
more interaction, I think, back then than now.
I think interaction is so important, and that's one of the reasons that the conference is so important to me personally. It was like we just have to do this. I know it's not what is the most profitable thing to do today, but it has to be done. We have to get together in person, and it was such a validation last year to get together with everybody in person, so many people in person, and it was so encouraging and motivating because this cycles business isn't easy.
Yeah, stock market business is not easy.
The stock market business is not
Yeah,
easy,
it's not a place where people who like perfection should hang their hats. That's for sure.
for sure. And one of the things I'm really looking forward to this year is you and Jake Bernstein being together in person.
Yeah, gosh, Jake and I go way, way, way back. When he was just starting, I knew Jake, and we got together in Chicago and have been friends. Watch our families grow up,
Mm-hmm.
suffered good and bad things together, and
Mm-hmm.
yeah, Jake has been an incredibly good and dear friend for 50 years now, 55
Wow.
years, something like that, 60 years, yeah, a long time. And Jake is probably the most prolific of any author in this business ever. I kid Jake. I said, Jake, you've written more books than you've read. And he laughs. But he's really has a large body of knowledge that he's contributed. And I just wish I had his energy. My gosh, I just, you know,
Yeah.
he's amazing what he's produced.
He is amazing. And what I'm particularly looking forward to is a special luncheon with you and Jake for our VIP and Masters Working Group members. So that's going to be a
You
lot
know,
of fun.
that will be one of the strengths of Jake Bernstein. This is not
Mhm,
widely known. People come to me and want me to mentor them. I have no idea how to mentor. I'm not a,
mhm,
I never took teaching classes. I don't know
mhm,
what even mentoring means for sure. But
mhm,
I said, go see Jake because Jake
mhm.
does that. Jake was
Yeah.
trained as a clinical psychologist,
Right.
and the feedback we've had from people who have mentored with Jake, they're not necessarily learning the markets from him, but
Right.
to get your act together as a trader.
Mm,
The
mm,
feedback has been phenomenal from people.
mhm.
So when we have lunch together, I
Right.
think they can check with Jake about yeah. There's we we all have basically the same indicators, but we have different outcomes,
Mhm.
which is really interesting. I was giving a seminar one time, real time trading seminar. I had a trade. It went up a couple days, whatever I got out of it, made some money. Another guy held on along, made a lot of money. Another guy got stopped out because the trade didn't work initially. And another guy said, that trade not going to work. He went short and lost money. Uh, we all had the same
Right.
indicators, but we had four different outcomes.
I
And
love that.
so why do we get different outcomes? That's where Jake really excels.
Yeah, there's some really interesting philosophical nuances in there, but we'll save that for another time. So, I was going to ask you. I don't actually know how you got into trading in the first place. I've heard you talk many times. I've met you a few times. I actually don't know how you got into trading in the first place.
The first thing was a stock market crash in 1962 when John Kennedy rolled back steel prices. The stock market crashed. I was in college,
Hmm.
Eugene, Oregon, University of Oregon, and
Hmm.
so I pointed to the newspapers. What does this mean? The stock went up. This was the day after the crash. The stock went up 1 point. What does that mean? 'Cause I didn't know. I mean, my dad worked in a refinery. I worked on ranches and stuff. I didn't know what that meant. And he said, "Well, that meant if you would have bought that yesterday, you would have made $100." I go, holy Toledo, $100 in a day without
Uh-huh.
going to work?
Uh-huh.
I'm in. I'm all in. How do I
Uh-huh.
do this stuff? Because I thought it'd be really easy. Just
Right.
guess if it goes up a point. Well, and back in 1962, $100, like my first car cost $100. It was a lot of
Wow.
money.
Okay.
So it was just, it was greed. I mean, I was like, whoa, this looks like easy money. Well, it isn't. It's a lot of hard work. It's the old cowboy sayings that you're too lazy to work and too honest to steal. So they're right. That's why I rode bareback when I was young. That's why I trade the markets. Like, yeah, it looks like the ideal business because you don't have a boss, you don't have employees, you don't have customers. Like, what could be better than that?
Right.
So to me, it looked like the ideal scenario, but I was frankly driven by greed, as I guess we all are to do what we do.
What would Larry today say to Larry from 1962?
Oh my gosh, do you know what you were getting into? But Richard, that's part of this grandiose picture.
Yeah.
I was set to do something else mentally in my life, and I ended up here in some predestined fashion,
Mhm.
some cyclical. I think so much stuff
Mhm.
is predestined to a point. We still have some
Mhm.
control over our lives, etc.
Mhm.
But still, like I never thought I'd end up doing this, and a lot of people
Yeah.
end up not doing what they thought they would do.
Right.
So I realized maybe 25 years ago, because I was trying other things. But no, Larry, this is your destiny. This is what you do.
Mhm.
Forget trying to do all these other things. This is your destiny. Get good at this. Perfect
Mhm.
this craft as much as you
Mhm.
can.
Mhm.
Uh, and I think stock market is destined to do certain things.
Mhm.
And
Mm.
to that extent, I guess we are as well.
Mhm. And you talked about like your time in Montana and being kind of immersed in nature and kind of becoming sensitized to cycles in nature. Yet you don't really, you're not particularly mystical about cycles. You seem to approach them very practically.
Well, that's because I went through so much stuff. I mean, when I was a kid, I fell for everything that came down the pike. I mean, I went to
Uh,
Tassajara, the Zen Buddhist monastery.
hmm,
I dabbled in astrology and, anything,
mhm,
Scientology,
mhm,
biology. Well, I tried everything.
mhm,
And eventually, well, wait, this stuff works or it doesn't work, right? And
mhm,
my sense was it may work a little bit, but nobody really had it all wrapped together in any one place. I realized, there's no be all one thing to do. And if we went out for dinner tonight, you might order steak and I might order lobster or fish or whatever. We all think differently.
yeah.
So you have to find the intellectual shoe that fits you. It could be Elliot Wave. I
Mhm,
don't get that at all. Yeah, Bob Proctor's a dear friend.
mhm.
I can't even begin to comprehend it. Um, but my mind just doesn't work that way. So you need to find that niche where you go, oh yeah, I get this real quickly. That's probably what you should follow. If it seems, if you're quickly to learn it, then that's the way your mind works.
And so, what cycles, how do you use cycles today?
Well, carefully.
How do you
um,
do cycles analysis? Do you sort of do it using math, or do you have some favorite cycles that you've come to rely on over the years? Do you
I
eyeball it like Jake does?
No, I like to use mathematical cycle predictors or projectors that will find cycles.
Mhm,
And I can look at a chart and say, yeah, there's a 30-day low, 80-day low, or whatever, but I need
mhm,
to know a lot more about it. Like I recently did some stuff on her cycles,
mhm,
the 40-day, the 60, the 9-year. What's the correlation to actual price fit? Do these cycles fit the price? So once you start to doing it, say, yeah, these are the strong cycles, and even then, Richard, as I see it, cycles are a condition. They're not a be all end all. They say this is a
yeah,
zone when I
yeah,
should be looking for a move. Now
yes,
my next
mm,
step is to go, I'm in that zone. What is the reliability of that move? And
mhm,
that's what I've been working on the last couple of years. Okay, we're in a cycle zone, and we should rally, say, for 3 months. Well, but the potential, the percent of times we rallied in that zone might be 40% because
mhm,
one was a big move. It looks like a big move on your chart.
mhm,
So there's waves within cycles, and I want to measure the accuracy of the wave within the cycle.
mhm.
But I wouldn't trade just because of a cycle.
So you've said, uh, don't predict A with A, or A doesn't predict A, meaning don't just use price to predict price, right?
Yeah, I think that, and I have some slides in a moment we'll look at that. I like to look at exogenous data. I
Mhm,
think charts move for reasons, prices move for a reason. So I want to look at those reasons. I don't think that charts drive the market on a very short day-to-day basis. The market closes way down, it's low. It looks like a horrible day. You're going to get selling tomorrow. If you don't, that's really bullish. So
mhm,
yeah, very short-term charts show the emotions of the day, but prices go from say $60 to $80 for a real reason. Earnings are up. There was a shortage of wheat, whatever it is. So I really
yeah,
want to get into the reasons as opposed to looking at chicken scratches on a chart paper, which I did for, I don't know, 25 years, 30 years maybe.
all right. Well, let's look at some charts.
Okay, do you want me to show my PowerPoints?
Yes, that would be
Great.
great.
Well, this is interesting. This is Anne Rand. I just loved her book, Atlas Shrugged. She always said,
Uh-huh.
check your premises.
Do you still love
So,
it?
oh yeah, absolutely. Oh, and I think Elon Musk is walked right out of the book, frankly. Um,
Elon Musk is John Galt, huh?
yeah, he's the closest we've seen. Yeah, he really is.
Mhm.
He's from another planet.
He is.
So I'll look at a cycle like the 18-year cycle is a really important one, but how does that correlate to actual price fit? About 40%.
Hmm.
9-year cycle comes in higher at 61%. So a 40-month cycle, a lot of people talked about it, it's a 50% fit. So if
Mhm.
I'm interested in a short-term basis, an 80-day cycle I got a 62% fit. Well,
Mhm.
if I'm a short-term trader, I'm going to look more at this time frame. Or if I'm interested in a very long-term 18-year cycle, I go, well, I have low correlation with this. So
So, did you pick those cycles out because of their correlations, or because those are sort of widely known cycles?
because these are what her set of cycles are.
First,
I
right.
didn't pick the cycles. These
Yes.
were
Very
his
good.
cycles.
Mhm.
So if I'm interested in that almost 18-year cycle,
Mm-hmm.
and I see the correlation is low, that may mean that within that cycle, there are waves that have higher correlation.
Mm-hmm.
So if infatuated with that cycle, I still want to break that cycle down to look at the waves within the cycle. There might be some really dominant, strong time periods within that 18-year cycle.
Mm-hmm.
So it just, but it already looks to me like, well, there's probably something that's going to help me predict the long term better than an 8 year, 18-year cycle.
Mm-hmm.
So I got to go look for it.
Mm-hmm.
Let's go to our next chart. This is what I was talking about. Exogenous data is a better predictor. Stock markets move because of, you can fill in the blank, whatever you think, astrology, GAN, trend line, whatever.
Mm-hmm.
I think inflation, rates, earnings, money supply, and futures production and demand. That's
Mm-hmm.
why I think markets really move.
Mm-hmm.
So instead of studying the cycles of, say, cattle, I'd a lot rather study the cycle of corn because cattle are fed on corn and fattened on corn.
Mm-hmm.
Or maybe a weather cycle. I know that hogs live a certain time period, about 44 months. So I want
Right.
that that cycle should be important in that market. I know there's a cycle to earnings. So as an example, like inflation, I think really is significant in our economy. So we can look at inflation, which is the black line, and the red line is a cycle. It's a real clear 6.3 year cycle in inflation. And as you know, with cycle, this means back in 2003, we knew inflation would go up because we knew this cycle way back here, over here. We knew this was a cycle projection, and look what happened.
So how
Inflation.
come that's not a perfect sine wave, Larry? What are the squiggles in that line?
The squiggles, I think, are randomness.
Okay.
That there's so much randomness that we're never going to have perfection. Plus, if I smooth this out, I would get rid of the wiggles. But I'm more interested in saying, what's this little wiggle up here?
Mm-hmm.
What's how much percent of time do we rally in that little wiggle, or maybe from this point to this point, maybe stronger than there to there. So I look at
Mm-hmm.
that. But for
Interesting.
inflation, it's like, hey, I want to know when inflation is going to pick up.
Yes,
So
6.3.
here's the same cycle and projected out from 2014. Cycle picks up. Oh, we're going to start to inflate now. So I think
Mm.
later this year and in 2027, we'll see inflation pick up in the marketplace,
Wow.
which raises the question. So what does that mean?
I
It's
know
like,
that I know you know that uh, amplitude doesn't predict price movement, but that does look like a very steep line
yeah,
there.
good point. Here it looks like, wow, black line went up this much, red line went up this much, black
Right.
line went up that, but here red line didn't go up much and black line did. Cycles tell us this area, this area, this area. They don't tell us the magnitude, as you
Right.
mentioned. So we don't know how big inflation will be, but I would think we're going to start to see inflation,
Yeah.
which begs the question, what does that do for the stock market?
Yeah.
So now I'm doing the exogenous thing. I'm looking at the cycle in red of inflation.
Mm-hmm.
At 1993, the cycle was turning up, saying, oh, look what happened to stock prices.
They
And
went up.
1999, they turned up and we topped in 2001.
So the blue line is the Dow Jones, and the
Blue
black
line,
line is
yeah, thank you.
inflation, and
Yeah,
the red line is the
the,
forecast, the
the
cycle
cycle, yeah.
of inflation.
Hmm. So, oh, there's an inflationary pickup here. Oh, look what happened to stocks. Inflationary pickup. Look what happened to stocks. So inflation
Sort of
can
not
be,
what I am trained to think, right?
of
Inflation
course not, of
up,
course
bad
not.
for stocks.
I know what we're trained to think of the biggest one, Richard. This is, I may drag this chart up and bring it this summer. Is that I think the leading cause of inflation is high interest rates.
Mm,
You want
interesting.
inflation, you increase interest rates and you get inflation. It's real simple. And
Mm-hmm.
there's a reason why, because if interest rates are high, people who have money are getting paid more interest on their money. And they have money, so they're going to go out and spend it.
Wow.
And people who don't have money, I better buy it now before rates go higher. So I
Very
think high rates,
interesting.
and I will show it this summer, definitely a correlation. High rates drive inflation because it increases money supply. And I'm just so absolutely clear of that. But anyway, we'll get off the point. So we know this is the red cycle of inflation, but at times, right, the stock market starts to come down. And I'll address that in a moment. But let's bring us up to date. So here's 2010, inflation picks up. Well, so the stock market, again, the cycle picks up. 2021 cycle picks up, and look where we are now. We're going to
Very
start to inflate,
interesting.
and that's bullish for stocks until this is where everybody agrees inflation is bad, but until when? Until it gets about 5%. When we're starting to inflate 5%
Mm.
per annum, then you got a lot of problems coming in the economy. But in the meantime, until we get to that level, and we're not at that level now, inflation is bullish. Richard, I really appreciate what you did. Richard gave me access to the back issues of Cycles magazine. I used to get it when a physical magazine came out in the 1960s and 70s. A big blue magazine came through the mail. Read through it, looked at all the cycles, all the incredible work that Gertrude Shirk had done. And I said, let's go back and see what we can learn from those back issues. So
Hmm.
this was from the July 1969 issue of the Foundation magazine. There's an article, Automobile Factory Sales in 1969 at a 13-year cycle. That was 1969. Now we're in 2026, almost 60 years ago. So I thought, let's look at these cycles and see, did they hold up? Is there persistence to cycles is what I wanted to know. And I've
Hmm.
gone through a lot of cycles in the magazines, and this is just one of many, but it's really interesting to me. Car sales, we're going to now look at total vehicle sales, has come from the U.S. Bureau of Economic Analysis, and it's published on the Fred webpage. Everybody has access to it. It kind of
Hmm.
looks cyclical, comes up or comes down. That's interesting.
It does.
So then I decided to see about that 13-year cycle, which is shown in blue,
Hmm.
against the black line, which is sales. In other words, the
Hmm.
black line is just what you saw here, right? But
Okay.
now I've put the 13-year, like, wow, look at that. And that, it's like, whoa, wait a minute. This is really
Yeah.
hot. Where have we been? Why didn't I pay attention to that magazine?
Wow.
Um, really intriguing to me. So carrying that forward, we see another cyclical low in sales. We see where we are now. We should start to decline in auto sales until about 2034, 35.
Hmm.
Okay, well, that's interesting, but I like exogenous data. So
Hmm.
if there's really a 13-year cycle in car sales, there should be some reflection of that in the price of Ford or General Motors. So that was a big question. Like, let's run a
Hmm.
13-year cycle. No optimization, no other Teslas. Let's
Right.
take stock data, put in a 13-year cycle and look at it. So this is what I found out. And Richard is like, wow, knocked my socks off.
Wait a minute. So let me make sure I know what we're looking at here. The blue line and the black line are the stock prices of GM and Ford.
That's right. The black is General Motors, and the blue is Ford, and the red is the cycle, the 13-year cycle projection. And
Wow.
I'm like, wow, it really called the 2020 low, called the big rally we saw in 2025. Said we should continue rallying until about 2027 is over, and the next big move in car sales is around 2030.
Hmm. To the
So
bottom.
it was like overwhelming to say all this information that the foundation had all these years ago
Hmm.
still has application, which whether I'm going to use this to buy or sell the stock, to me, it's an academic question of is there cycle persistence? Do cycles hold up?
Yes.
Because if they do, then I can use them in making decisions. If they don't, well, I'm chasing my tail. But I've seen enough because I've done numerous studies based on the old Cycle Foundation magazines and took those into the future, and they're there. They're there.
So how would you use this cycle, Larry? Would you just, I know you, one of the things that's important to you is trend, and so that stock prices trend up over time, and that cycles are better at calling bottoms than tops, especially in stocks. So would
So
you say not really, just hold off on buying auto makers
It,
until 2029. Is that what you do with this?
yeah. I mean, it's to simplify, if I really liked an auto stock, I'd want
Hmm.
to come in and look at what about this wave for the middle of 2026 into 2027?
Okay.
What
Right.
percentage of time have we seen a rally?
Yeah.
In General Motors, well, General Motors have been a lot stronger than Ford, so I'd want to look at General Motors and say, okay, because they have a real big wave cycle here, but how about this wave? Do I want to do a lot of short selling in this wave?
Hmm. Very
These
good.
these waves are going to be my trading opportunities in the market.
Fantastic. Oh,
So
that is
this would be
great.
my
I love
next,
that.
like, yeah, we could have a buy coming up. Looks like maybe March, April this year. I'd have to go in and measure that and then see, okay, how reliable, how valid is this wave? Is it just a little something like this, or is it the start of a significant wave?
Right. Very nice. I love that. And so let me see if I can kind of sum up. So I love how you're looking at exogenous events. A doesn't predict A. Don't just use price to predict price. Try to understand what's driving the cycles. So you shared with us today that you think the biggest driver of stock market prices is inflation
That's one of
and
them.
interest
It's
rates.
not the only
Or
one.
one of them.
There's numerous, but it's the most topical one. Everybody talks about inflation every day.
Right. And so inflation you're predicting is going to rise in 26 into 27,
Yes,
which will likely mean higher equity
stock prices.
prices
Right. Yeah.
and interest rates, which was interesting.
And interest rates. I didn't do an interest rate forecast here. I don't recall what it
Hmm.
is, but the bigger thing in rates, of course, is that lower rates uh, cause less inflation. Higher rates cause inflation.
Right. And higher rates cause inflation. I usually think inflation causes higher rates,
I
but
know
it's
that's what
interesting
everybody
that
argues.
you say
That was a Paul
higher
Volcker
rates
argument.
cause inflation.
Absolutely. I will show it this summer. I'll bring my charts, and you'll
Okay.
see where we have inflation and we push forward the cycle of
Yes.
interest rates, and you'll see inflation goes up when the cycle of interest rates says interest rates will go up. Well, inflation goes up. We can
As
predict.
long as we don't get above about 5% in what, the 10-year yield?
Well, then no, that isn't. That's more for inflation in the stock market. But I
Okay.
don't know an absolute value there, but clearly, and it's part of modern monetary theory. It's not my idea. Warren Mosler, a friend of mine in the Virgin Islands,
Mhm.
came up with a notion. It's more widely accepted now,
Mhm.
that for two reasons. One, when rates are high, people go out and buy stuff because they're afraid it'll go higher.
Mm.
So
Mhm.
that increases prices. And the others,
Mhm.
people that are getting interest checked were getting 5% of the money, now they're getting 13% of the money, and they have money. That's why they haven't invested. They're going to spend that money.
Yeah. I know
Yes,
that's
it's
kind of
clear
where
driver.
my head's at right now. It's like anything, if I think about a significant capital investment that I have to make over the next 10 years, my mindset right now is do it now because it's going to be more expensive 5 years from now.
Another good driver of inflation, and it makes sense as well, is the stock market. I can show that this
Mhm.
because the thing, when the stock market rallies, people have more money. When people have more money, they buy stuff.
Yeah.
So it all the basis of the Austrian school is right that more money in circulation causes inflation. But okay, what puts money into circulation? M2, M1 in the old days, or higher rates? A big rally in the stock market.
Hmm.
Um, and
Very
those are
interesting.
driving forces.
Very interesting, Larry. So I know you're actually writing a book on cycles.
Yeah, I don't know if I'll ever finish it, but I decided I kind of semi-retired. I'm going, yeah, what am I gonna do? Go feed pigeons? No, I tried that. That didn't work.
Hmm.
Like I got to do something in my life. So I thought, well, I'm going to write a book on an historical thing that I'm very involved with. And
Hmm.
I have arthritis. I never learned to type. So for me, it's like hunt and peck. And I'm going to
Hmm.
do it about cycles because that's
Hmm.
like such a passion that I have.
Hmm.
And so I've started the book. Who knows where it will ever go? But
Hmm.
I've got 5 chapters into it so far. And hopefully someday it'll see the light of day.
And what you shared with me that one of your hopes for the book is that it would reach some of the policymakers and the Federal Reserve, for example, and alert them to the inflation that's coming.
Yeah, and the idea is, when Arthur Burns was a member of the Foundation of Study of Cycles, I
Hmm.
think there was a concern about cycles. But now you read all the papers of the Federal Reserve, they don't mention cycles. They mention all sorts of econometric formulas. They go,
Right.
guys, 2 years, 3.5 years ago, we said inflation is going to go down. It did. So if the Fed, and maybe they did know that, and they didn't tell us
Yeah.
that, but I knew inflation was going to go down then, and it did. So they could have adapted monetary policy knowing in advance, and we would have
Hmm.
had a smoother economy. So maybe
Yeah.
they know these cycles, they don't talk about it.
Hmm.
Um, and whatever the case, at least we as a public should know, hey, I got to be thinking about this. We're going to start to inflate, and that means stocks will go higher. When it gets real high, I want to get out of stocks, and I want to protect myself, and I want to buy bonds because I'm going to get a real high rate of return on my money.
Hmm.
So if we can see a little bit into the future,
Hmm.
we're kings in this world.
And I know, speaking of that, I know you have some concern about, say, like 27 to 32, roughly.
Yeah, I wish I was smart enough, to figure all this stuff out. I think there's a bear market coming. Not yet. You got to be so careful being bearish. Just all these people, it's the end of the earth. It's the end of the earth. But well, the Earth's been in what 4.2 billion years, and so far every end of the earth guy's been wrong. So those are bad odds.
Right. Those are bad odds.
And we've had one major crash, well, actually two. A crash in 1929, which I don't think we'll ever see again because we now have the Federal Reserve System. And 1970 was a real bear market. We were down for a couple of years. That was a
Mm.
real bear market. Everything else, the market is down for 6, 10 months, boom, pops right back up.
I mean, I remember March of 2000 into 2002.
That was interesting. It was different in the Dow than it was the S&P or the Nasdaq.
Okay. Yeah.
And we're seeing that right now. The Dow has been stronger than the Nasdaq has been.
Hmm. Hmm.
Maybe this is happening again. So as you
Yeah.
get to these turning points, you have to judge like what's what's the soup du jour here. What's going on in the marketplace. But we're alerted in advance. I'm convinced by cycles.
All
George
right.
Marshall was able to do it with his forecast for President Roosevelt. We can
Hmm.
even get better at it now.
Hmm. Well, whether your book sees the light of day or not, it will see the light of the Cycles Conference in May
I'm
of
I'm
this
gonna I'm
year,
gonna
right?
bring I'm gonna bring some really juicy stuff. You bet,
All right.
absolutely.
Oh man, I'm really looking forward to it. And I just gotta ask you one last thing, Larry, because I asked you this once, and I'll never forget your answer. Where I asked you, what is the most important factor in your success? And you said knowing how to ride the bull for 8 seconds.
Yeah.
So can you just talk about that a little bit for other people who are contemplating a life of ease in the markets?
Well, if you don't know anything about rodeo, you have to stay on your horse or your bull for 8 seconds. Doesn't seem like much time. Looks until you get on the bull, and those 8 seconds, or in my case, bareback or a bareback, for
Mm,
8 seconds is an eternity. It's
yeah.
like it's 2 years in 8 seconds, and because the time frame warps so much, you're getting
Mm,
bucked, and you're worried about it. And same thing in the
mm,
markets. I mean, there's the easiest strategy. If I would have been really smart, I would have borrowed $100,000 in 1962 when I started, bought stocks, and went to bed under an electric blanket and woke up now. I'd be worth, I don't know, $15 million or something.
hmm. With no
So
stress,
with no stress,
no
none,
bowls.
no bulls, no nothing. But I held on, right?
Yes.
So, like I said, the example where we had one, I had a signal real time trading, right? One guy lost money, one guy lost a lot of money. I made somebody, another guy made even more money than I did. Um, it's the outcome of how you do, and it's based on your ability to have patience, your ability to persevere. I've had, I don't know,
Yeah.
millions of trades, but I don't know, I've ever had very many trades that were successful from the absolute tick I got in. They were never against me and went straight up and made a lot of money.
Yeah.
I don't buy the absolute lows or sell the absolute highs. They're back and forth. I'm up and down, and unless you can live with that emotionally,
Right.
uh, hold through that, you're going to get out at the wrong time.
Right. Kind of brings new meaning to the idea of a bull market.
Yeah,
You
the,
think, oh
the
yeah, bull market, great. No, bull markets are tough to endure. I mean, think of like, I mean, the gold and silver markets here recently, right? They've been,
It's
um,
hard to hold on. It's human
it's
nature.
hard to hold on.
Human nature is to get out. So if you get a winning trade, you need something that'll keep you in that trade for
Yeah.
whatever the time frame you're trading for, 5 years, 10 days, whatever it is. I need, in my case, I'm such a weak person, something mechanics is alert. The trend is you got to get out here, cowboy, or
Mm-hmm.
continue holding, continue holding, continue holding.
Yeah. Yeah.
Something that will assist me in doing that, other than me just saying, "Oh, it looks like this way or that way." I'm not that good at that, so I like
Yeah.
something mechanical that says this is a trend change here.
Awesome. Well, Larry, I could talk to you for hours, but I really appreciate your time today, and I'm really looking forward to being together again in New York City at the end of May for Cycles in the City 2026.
It's going to be thrilling to be there. I'm looking forward as well, Richard. Thanks again for doing this, and thanks in advance for this summer. It's going to be a crackerjack.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
Foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.